To understand the roots of the relationship between gold and US dollars, we have to go back to the international monetary system after World War, to which was dubbed the Bretton Woods system, after the meeting of 44 countries in Bretton Woods, New Hampshire in 1944. The countries agreed to keep their currencies connected to the dollar, and the dollar was fixed to gold. US dollars were convertible to gold at a fixed exchange rate of $35 an ounce. The United States had the responsibility of keeping the dollar price of gold fixed and had to adjust the supply of dollars to maintain confidence in future gold convertibility. Initially, the system operated as planned, as the demand for US goods and services and dollars was high in the 1950s. However, in the 1960s, European and Japanese exports became more competitive with US exports. The US share of world output decreased, and so did the need for dollars, making converting those dollars to gold more desirable. The deteriorating US balance of payments, combined with military spending and foreign aid, resulted in a large supply of dollars around the world. Meanwhile, the gold supply had increased only marginally. Eventually, there were more foreign-held dollars than the United States had gold. By 1971, the US had a deficit in the current account with many countries. The situation was similar to what President Trump is talking about today. Moreover, the US suffered from high inflation and high unemployment rate. Therefore, President Richard Nixon administration coordinated a plan for bold action based on the advice of a group of economic advisors, including the head of the Federal Reserve at that time, Arthur Burns. On the evening of August 15, 1971, American President Richard Nixon addressed the nation on a new economic policy that not only was intended to correct the balance of payments, but also reduce inflation and lower the unemployment rate. The first order was for the gold window to be closed. Foreign governments could no longer exchange their dollars for gold, which means, in fact, that Nixon canceled the rule of converting dollars to gold at a certain price. The second order was for a 90-day freeze on wages and prices to check inflation. Shortly after the plan was implemented, the growth of employment and production in the United States increased and inflation decreased. The plan proved to be successful. The relationship between gold and the US dollar has historically been inverse. When the dollar strengthens, gold typically weakens, and vice versa. This relationship is grounded in several fundamental market principles. As gold is priced in dollars globally, a stronger dollar means it takes fewer dollars to buy the same amount of gold. Moreover, when US interest rates rise, which means higher rate on US bonds, gold becomes less attractive as a non-yielding asset. Therefore, generally the higher the rate on US bonds, the less demand for gold, which leads to decreasing gold prices. However, both dollar and gold rise together in the time of geopolitical tensions, including the Russia-Ukraine conflict and the Middle East instability. In such situation, many investors are demanding both gold and US dollars.